Hello.
Hello. Hey.
Hi. Good to see you.
Good to see you. Glad you can see my picture.
I can, yes.
I'm in the background cooking lunch, so I'm off
Oh,
camera
good.
for now.
No, that's totally okay. All right. Our chat is starting to fill up here, or meeting participants. So we'll just give folks a couple of extra minutes to trickle in before we get started. And in the meantime, if anybody wants to pop off mute, say hi, or ask a question. Feel free. You're always welcome to do that. Hope everybody's doing well. And this is our April Wealth Wednesday. And I'm in Colorado, and it was like feeling like summer a couple weeks ago, last week, literally. And we were walking around in tank tops and shorts, and today it's snowing. So
I see
that,
you're in a sweater. I like your
yep,
sweater.
sweater weather again. So that does
Wow,
sound right for our April.
that's crazy. I think it's supposed to be 90 here today in Austin, which I'm okay with.
That's a little, I mean, I really, when I felt like it was too hot last week, it was like in the high 60s. But it's so strong in the sun here,
Yeah, that's true. Yeah.
and we were still trying to ski, so that's pretty hot ski weather.
I'm surprised you still have any snow if it's been in the 60s.
Yeah, it just every day was a new picture of the mountain, literally. Like the white ribbons were getting smaller and smaller and smaller every day. It was drastic. And
Wow.
even the snow that we're getting right now is probably not going to do much to make up
Mhm.
for any of it. So, and end of season anyway, so that's all
Yeah.
right.
Is the resort still open?
Yes, until Sunday. Sunday's the last day of the season.
Are you gonna try to go this weekend?
Yeah, yeah, we'll have to go, you
Last
know,
couple days in.
yeah, give it a good closing day.
Do essentially some water skiing down the mountain.
Yeah, yeah, exactly. That's how it's been feeling. Okay, well, I want to get started, and as always, we can leave plenty of room for questions throughout the presentation and at the end. So just yet another reminder that if you have a question to ask, feel free to either come off of mute whenever, throw it in the chat. You can always raise your hand, and um, we'll also, just kind of make sure that we have some time to open it up at the end for questions, discussion. And just as, a quick reference for those who haven't joined a Wealth Wednesday call yet, this is a series that we do just to try and spark more conversations within our community about money, and really trying to normalize women being able to talk about wealth, and really being able to grow some knowledge as well as get some new insights, and feel like that you're not alone when you have questions, and that you can grow with this community. So if you're new to our Wealth Wednesday session, then welcome. And if not, then we're glad to have you back. And today we're going to be talking about um, what to do with whatever extra cash that we might have, or whatever debt that we might have. So when it comes to either paying down debt or keeping money in savings or taking some of that money and investing it, what are some guidelines and how do we make those decisions? And we feel like this is always an important question. It's never an easy one to answer because, as is pretty much all of personal finance, everything really always depends on your personal situation, not just your numbers, not just your financial picture, but also the other human factors that go into that. And so we're going to talk about those today, but especially in an economy like what we're seeing right now, there's a lot of fluctuation, there's a lot of uncertainty. We're seeing so much volatility in the market, especially right now. It's the bad kind of volatility in the market, where we've been exposed in the last couple of years to the really like nice volatility of the market. So this just makes it, I think, even harder to decide what to do with our money, where we're like, you know what, is if I have extra savings, I'm not even sure that I want to plug it all into the market because the economy is making me nervous. And what if I, want to have some extra cash lying around for being able to, support myself if things go
You
south
forget
for
us.
yeah, exactly, exactly. So that's what we're going to be talking about today. I'm going to open up my sharing and then dive in. Let me also, okay, making sure that our recording is on. And as always, we have our disclaimer here. This is an educational series. And when we provide um, input and information in this forum. This is meant to provide education at a general level. So we're not giving any one of you, any one particular person watching the recording, financial advice. When it comes to one-on-one financial advice, that's when it's time to contact us one-on-one, contact another financial professional. But either way, just a reminder that this is an educational series and we're not giving financial advice. So let's kind of talk about before we even get into, some helpful guidelines and numbers, that, just to kind of give the boring answer that I think most of us don't love to hear a lot. But also I feel like this can be encouraging, knowing that we have some flexibility here and it's not just like always a black and white answer, is that there is just not a single answer. You can't just say, hey, I need to know the right thing to do. I need to have like the same compass as everybody else in order to make my decision here. And, I know that can be really frustrating because a lot of times we just need the simple answer and we need to get out of decision fatigue. Um, but I want to throw this out here to also set the stage that, if you're struggling, if you know that, that you've heard before that you should be not paying down a certain type of debt, or you should be paying down another certain type of debt, or you should be saving this much, or, you should be investing this much, and it's not sitting right with you. I just want to encourage you that might be for a reason. So it's not always that we should be listening to a very specific formula and applying that to our lives. It's that, each of us has a very different risk tolerance. We have a very different situation as far as how stable we are, how stable we feel. And therefore, there's no one right or wrong answer that says this is exactly when you should be putting more money into savings. This is exactly how much money you need to have in cash to provide yourself with the right safety blanket. So I felt like it was important for us to begin our discussion like this. And if any of you feel that way, I just want to acknowledge that often that's probably because in your gut, you've got a real reason to believe that, that whatever the mainstream advice might be when it comes to certain guidelines about when to save, when to invest, that might not fit for you. And you should always be listening to that and always make sure that you're understanding, based on my personal situation, what makes sense here. And we are going to talk a little bit about what different scenarios might exist, like such as what might exist in your specific life. And we're also going to talk about some other human factors. But if you have anything that's on your mind, just shout it out and we can talk through that as well. So some of the pieces that we're going to outline in this presentation contain some guidelines, but I want to make sure that you keep in mind those guidelines are not hard and fast. So if they don't sit right with you, it's probably because you've got something in your situation that means that you should behave a little bit differently than what these guidelines suggest. So let's first talk about what I think is the most important. So I know we'll talk about like when to pay down debt and when to choose to invest instead of paying down debt. But really, it's so important to acknowledge that building an emergency safety blanket is so vital. And one of the things that we often ignore is that a major reason that people fall into severe debt is because they don't have an emergency savings that they can tap into, and therefore they wind up taking on really catastrophic and expensive debt. So having emergency savings, it doesn't sound sexy, it's not kicking out a big return. When we talk about emergency savings, we're talking about putting your money in a place where it's accessible. And usually, when we're putting our cash somewhere that's accessible, it means we're not getting a really exciting return on that money, especially lately. If your money's sitting in a money market account or CDs or a high yield savings account, you're watching those returns, clip down little by little every quarter or so. And that's frustrating. And you might be kicking yourself and thinking, is there a better way? Should I be doing something else with this money? Um, and one thing that I would say to hopefully calm that voice inside of your head is that you are you are keeping your money where it needs to be for a rainy day, and that's really important. So that money still has a role to play in your portfolio, even if that role is not touting about its high return. So I just want to settle your nerves a little bit and talk about why it is so important to have that emergency savings. Now, of course, you might be in a position where your emergency savings has gotten bigger than you need. And that's a different story. That might be an opportunity for you to take a look at that excess and say, okay, maybe I don't need this to be as accessible. And therefore, there are more exciting returns I can get on this money. But what I am talking about is that amount that you really need to keep in an emergency savings fund for a rainy day. And what does that mean? When we talk about emergency savings funds, first of all, the how much do you need is a really important question. And obviously, nobody knows, nobody has a crystal ball as far as exactly how much, when might I need my money and exactly how much of it I'm going to need and for how long. So once again, these are general guidelines that are based on data. When someone loses a job, how long are they unemployed? And we have talked about the 3 and 6 month emergency savings fund rules. And just to kind of give a recap on that, what we're looking for is typically, on average, it's between 3 and 6 months of expenses. So how do you know where you fall into that, or if you do? And 3 months of expenses, we're talking about living expenses here. So you might be putting money away every month that also is going into savings, that might also be going into either like an education fund, retirement fund. When we talk about emergency fund for living expenses, we're not talking about how much you're putting away for retirement. So I do want to make that distinction. Typically, when we are saying this is how much works for a lot of folks in an emergency fund, those are the living expenses. That means contributing to a retirement account, contributing to an education fund. Those activities are usually suspended when you're tapping into your emergency savings. So this is living expenses only, and 3 months is a guideline that tends to work for people who have multiple streams of income. 3 months is riskier, right? The smaller number of months that you have saved for in emergency situations, that will be riskier. Whereas if you have a lot of months saved for, that's increasing your security blanket. But again, the reason that we want to walk this line is because we know that we're not getting much of a return on our emergency funds. And therefore, it's really about balancing. I want to have enough to feel safe and to be able to tap into if I lose my job, if every provider in my household loses their job. And yet, I also want to make sure that the rest of the money that we have is being invested for, a return that is really helping us grow. And when we sacrifice on that return significantly, that's also a risk. So what we're doing with our emergency fund is trying to walk that line and making sure that we're honoring the right amount of security blanket that we need without putting too much in there, because the rest we do want to have a better return.
So,
So
Caitlin, what's your opinion on if you have access to a line of credit? So, say, you could borrow against your stock portfolio, or you have like a home equity line of credit. Can that count as your emergency fund? Do you feel like you should count that as your emergency fund? Because technically you could pull money out, but it's going to
right.
be at a high interest rate.
Yeah, exactly. It's gonna and it might be at a high interest rate, it might not be. Like, let's take an example, maybe even from like 7 years ago, right? Where um someone could tap into a line of credit that was pretty cheap money when interest rates were low. Especially most, you can find a line of credit typically where the first period of time, like 5 to 10 years, is interest only. So you're taking out a loan and potentially with a low interest rate, and you're only having to pay back the interest for a period of time. And what I would say is that uh, I personally feel like it's a very risky move to rely on a line of credit as an emergency savings fund. And the reasons are is because you're still racking up debt, right? So you're kicking the can down the road. And I think that's riskier because the debt is also likely to increase, right? So for one, most lines of credit are an adjustable interest rate. So you could be putting yourself in a position where, 6, 12 months down the road, you're now in an interest situation where interest is so high and you can't pay it. And two, your interest only period has a timeline on it. And debt is something that it, it it's up to each individual to understand how they handle debt. Sometimes when people have the door open to be able to take money out and take on debt, they might not feel as disciplined to really pay that down. They're, on the other side of the spectrum, some folks might feel very disciplined, but overly so, it might really wreck their mental state, and they're feeling anxious all the time because of that debt. So I think that wherever you fall, it can create a pretty risky situation, which is why I would say that is an absolute last resort, if any resort at all. My personal preference
Probably
is
say credit cards are the last resort.
true. Yeah, yeah.
But
If,
yeah,
if
I do know, I've heard that, in talking to other finance professionals, some of them say, oh, well, if you have a line of credit, you don't even need an emergency fund because you
mm,
can always just tap into that. But I agree with you that I think it is risky to take on debt, and it is essentially almost saying, oh, well, I could just put it on a credit card, which is also not a great thing.
yeah,
Uh,
yeah, and arguably worse than a line of credit for sure, because line of credits tend
right.
to give you better terms and a little bit more flexibility. But where's your line of credit coming from? You can find yourself in a situation where you're putting your home at risk, right? You've got a mortgage and you take out a line of credit on your home, and now you're tapping into that line of credit in order to provide you with that emergency savings. And if you've gotten to the point where you can't even make the interest payment on that line of credit anymore, you've put your home at risk. So it can create a really risky situation, which is why I would not agree with the recommendations to just rely on a line of credit rather than an emergency savings fund. And I have heard that, Susan, too. So it's not wild to think that people are out there saying that that's not a bad idea. I would absolutely counter that and say, if you've got access to a line of credit, then great. That can be like one of your last resorts. Use the emergency fund first. Or if you get to a point where you're like, okay, we've lost our income, we have to tap into our emergency savings, you can be in a position where you're potentially like, okay, how much should I pull from emergency savings? Does it make sense for us based on the terms of our line of credit to use some of that? Which is very, very situational. I think a lot of factors would go into the decision of, should we just use a little bit of our emergency fund and then otherwise use that line of credit. But yeah, I would say it is safer to have the cash and not to have to crawl into debt, because that's the whole point of having an emergency fund.
Okay, great.
I think that's a great question.
I know that I kind of went off on a tangent, but I have heard that, and I have heard people say, "Oh, well, I don't need an emergency fund because I have the line of credit." But yeah, I think I totally agree with you.
Yeah, yeah. And then, some more guidelines here as far as what's the time frame that you choose for your emergency savings fund. So like I mentioned, 3 months, that's riskier, but it could work if there are multiple streams of income. So if you lose one set of income and you have others to fall back on, then those are good options. And therefore, that can really justify saying, why should we save more than 3 months of our expenses, because we could potentially fall onto these other streams of income. So we might not make as much as normal, but we can cut back and still live off of those multiple streams of income. Maybe we need to tap into that emergency fund, but just a little bit until we find another source of income. So that's an example of why you might choose a shorter timeline for your emergency fund. Whereas 6 months is definitely more standard, and that is a good guideline. I think if there's single income or you have dual income in your household, but you really, there might be an income disparity and you're relying more on one person's income, there's a lot more risk then, right? That you're relying on that one income. I would say treat that as a single income household, because if that one income stream is lost, then you're in a position where the other income might not be providing for nearly as much of your living expenses. Um, and then it doesn't hurt to go beyond that, except for the loss of return that you'd be getting by just storing more of your emergency fund in a cash equivalent way. So if you go beyond those 6 months, 9 to 12 months is a guideline that's used for folks who just maybe feel a little bit more anxious. And peace of mind is definitely part of our financial decision making. So that is a financial return. And if you feel like you need that extra peace of mind, there's nothing saying you're really doing something wrong by having an additional buffer, and therefore potentially storing away 9 to 12 months of living expenses. But another reason that you might not do that, even if you don't feel like you're particularly anxious when it comes to money, or when it comes to the longevity of your salary, is that maybe your household is relying on self-employed income, or unpredictable income. And, there might be self-employed income that feels very stable. So that I would say that's not in this 9 to 12 month guideline. But absolutely, if it's unpredictable income, if it's seasonal income, or if you have high fixed expenses. So that caveat I think is important, because a lot of times if we find ourselves in a situation where we've abruptly lost income, most likely we're going to say, okay, I'm not only going to try and gain more income now, but I'm also going to try and figure out how I might be able to cut expenses. And some of us might have really high fixed expenses that just don't have flexibility to be cut, right? Maybe our mortgage is really high. Maybe, our medical bills are really high, and we just know that we don't have the opportunity to change that. Those are examples of where we might say, I want to build a bigger buffer, and therefore a larger emergency funds, such as within that 9 to 12 month time frame. Um, so just kind of going back to what's the risk of having too much money in your emergency savings funds? Why would you not do that if you just want to feel like really safe? Well, again, when we talk about our emergency savings, we're talking about money that can be accessed to us like in a quick way, like I need that money tomorrow, and in a way that doesn't require us to lose our principal. So, for example, if I have all of my money in high growth funds in the stock market, that's awesome, because most of the time I'm getting a great return on that money, but not always. And I can't predict when that fund is going to take a nosedive and suddenly I've lost 40% of my portfolio value. And that normally doesn't matter unless we need access to those funds, right? Because a 40% loss in our portfolio when the market goes down, that's not a realized loss. As long as we can hang out and say, that's all right, it took a nosedive this month. In the next several months, hopefully it's going to start going back up. We know that in the long run, it will, like, make up for that loss. But if we don't have the time to wait for that, and we actually have to cash out when the value of our portfolio has dipped, then we actually have realized that loss, and we don't want to lose money. So that's the whole idea of having emergency funds in cash or cash equivalents. So what are we talking about? High yield savings accounts, money market accounts. We can get more complicated by going into like a laddered strategy of CDs or bonds. I would say that's really not necessary when we have tools like a money market, or high yield savings. The reason you might go into like a laddered CD or bond strategy is if you're like, you know what, I've got a lot of money that I want to put in my emergency savings fund, and I can eke out like an extra, you know, 0.75% on my money if I do this laddered strategy, and therefore that might work. I've got Roth contributions on here because it provides you with another location where you have the potential to pull money if needed. Roth, it's really important to make this distinction that the contributions that you've made to your Roth account. So let's say I've put in $40,000 into a Roth IRA over the last couple decades, and that $40,000 has grown into $160,000. Well, it's the $40,000 that I have contributed to my Roth. That value is what I am able to pull out. There's not a requirement that I have to be a certain age to pull that out. So it's really important to make that distinction. I know that this is kind of a hot topic to talk about when it comes to having a Roth IRA and the flexibility of it, but it is important to make sure that you're only pulling out those contributions to avoid penalties. And there's a lot of nuance when it comes to having a Roth IRA and being able to use funds prior to retirement. So that's definitely something that if you're unsure about the rules, it probably does make sense for you to work with a professional to help you and make sure that you're avoiding tax implications and avoiding penalties. But the reason that I add that is I always like to have the idea of like another location. And in a Roth IRA, like in my Roth IRA, everything is very high growth focused, right? Because a Roth is a tax-free account. So I want to get as much growth as I possibly can in that tax-free account. So if, I'm looking at my emergency funds and I'm like, okay, well, I can grab this much from my money market, but actually there are these funds that are in my Roth that have done well, and they're, not doing so bad right now. I potentially could pull, my contribution amount from that Roth if I wanted to maintain my emergency savings fund elsewhere, or if I just wanted some more options. So that's the reason that I have Roth contribution as a location here. And Susan, feel free to chime in if any other options come to mind. But when we talk about emergency savings funds, again, going back to like there's not a lot of glamour in these types of accounts, and it's supposed to be that way. It really is just like you're not doing much investing with your emergency savings fund, but high yield savings is better than like getting 0.01% return in your regular savings or checking account. So do make sure that you're getting like at least a few percent, um, when you can on that money that's sitting there. All right. So when should we build more savings? This kind of goes back to those timeline guidelines, and you might be sitting here feeling like, you know what, I feel like I've done everything right. I've played by the rules, and um, I'm just starting to look at the stock market and hearing all of this news about AI, and I am not so sure that I'm like really sitting in the right place. And um, if you're trying to figure out like, is this a time for me to build more savings or not? Again, this always depends on our specific financial situation as well as all of the human factors that we feel when it comes to volatility and like losing value in our portfolios when the stock market dips. But it is important to consider real factors such as how variable is your income, or are you commission based, or are you in an industry that you see is potentially at risk? And if that's a case and you've got some red flags going off, it's not a bad idea to put more money into your emergency savings. And sure, that means that you're potentially like taking a little bit out of the money that might be automatically going into investments every month, but nonetheless, you're providing a little bit of an extra safety blanket. So if you feel like you have red flags going off and kind of go through the checklist in your head. Is it because your income is variable? Are you commission based? Are you in an industry that you're feeling like could be at risk? And I also just want to remind you that you're not only you're left to the choice of, you know what, all I have to do is just shove more money into an emergency savings fund and not invest that money or not contribute more to my retirement. There are other things that you might be able to do to feel like you are growing some more stability. So always, you know, it never hurts to have more streams of income. It never hurts to build up your skill sets. And we are not meaning to do like an AI deep dive here, but you know what things that we keep hearing are how to kind of career proof your life or AI proof your career, and you know, what are some things to focus on in this time where AI is potentially taking over so many jobs. And you know, absolutely, one thing that we keep hearing is brush up on AI, like really understand how you can use AI and how you can make that a big strength of yours in order to do your career better and do your job better. And also, you know, what are the human elements that you provide that AI cannot replace? And these these go beyond just the AI black hole that we've all found ourselves in lately, I think, but really like how can we refine our skill set? How can we um, redefine ourselves? How can we potentially, you know, pick up some additional income streams? It's never a bad idea to think about that, but if you find yourself where you're in a position where you're feeling like there's a lot of risk in your industry or your particular career, start thinking about those things as well. It doesn't have to be a knee-jerk reaction that, you know, you just need to stuff more money into your emergency fund, unless you feel like your emergency fund is definitely on the low side. Um, and then if you anticipate big expenses in the next 1 to 3 years, this is also an opportunity for you to say, okay, hold on. Like if I had all of this money in the stock market and I kind of had earmarked some of that money to use on a new home purchase or renovation or, you know, starting a new business or taking a break from my career, then you might be in a position where you're going to be way better off earmarking money that is in a more cash or cash equivalent location. So, you know, start to think about what kind of big expenses are coming down the pike in the next 1 to 3 or even 5 years, and plan for that. Don't just assume that the stock market is going to keep pumping out 22% returns and you're going to, you know, park that money until the month before you need it and get to realize all those returns. So definitely start looking at your strategy for where that money is going to come from. And obviously, it's going to give you more options if most of that money is coming from cash or cash equivalents. We've talked a lot on these Wealth Wednesday webinars about having diversification in your portfolio. And this is yet another reason why, is not just because, you know, you want to see different parts of your portfolio still hanging on when other parts of your portfolio might be really suffering from whatever economic instability there might be. this is another reason, having diversification in our portfolio allows us to say, you know what, I can get a little bit of my money from there. I can get a little bit of my money from here when needed, when, that normal bread and butter of my portfolio is not performing the way that I want it to.
And we talk about dollar cost averaging into the market where you put, $1,000 in every month or every paycheck to kind of spread that risk over time. Well, you can do the same thing, right, when you're pulling money out of the market. So you can dollar cost average out of the market. And so if you are saving for a home purchase and you know that you're going to need 100,000 in cash, well, you could pull out 5,000 one month, 5,000 the next month. You don't have to go in and take all of it out at the same time, too. And
Absolutely.
that can kind of spread your risk out just in case the market does fall suddenly.
Totally. And I love that idea of thinking about dollar cost averaging in both directions. And it's funny because my sister is visiting me and we've been having a lot of like nightly conversations about her plan because she's preparing to take a career break. And several months ago, actually, she sold a property that she used to live in, and then that had been rented out for a little while. And she was like, I don't feel comfortable putting all of this into the market. Like, what should I do with all this amount of money that came from that sale? And so we talked about dollar cost averaging then. And then now, as she's preparing to take this career break, which she's, preparing in the next several months, we've talked about the reverse dollar cost averaging, how to then say, instead of saying, I'm going to need this much money because I'm losing this much income, like let's take a look at where some of your expenses can be covered and see a smaller amount that you might be able to pull more incrementally rather than just saying I need to pull all of this money out from one place at one time. So I love that idea of dollar cost averaging going in both directions because the whole idea of dollar cost averaging is that it keeps us disciplined and it helps us psychologically deal more with volatility in the market. So it helps us invest when the market is high and things are more expensive. It helps us invest when the market is really low and it feels scary, but things are on sale. And same way, it helps us take money out at, incrementally when needed. And just it's such a great psychological tool in addition to like a nice disciplined financial strategy.
Yeah, and studies have actually shown that people that dollar cost average both directions actually do better than people who try to time the market,
Mhm.
right? They try to sell everything when they think it's at the peak and then try to buy back in at the bottom. Those people don't perform as well as the people who are just consistently, putting $1,000 in every paycheck.
100%. And that always makes me feel better because I don't trust myself to time the market. Even no matter how much I catch myself trying to do it, I will say that. Like, uh, despite how often Susan and I talk about, like, we're never going to be able to time the market, and you won't either. Stop trying. I still catch myself wanting to say, you know what? I've been meaning to sell this one thing, and I think I should wait like just one more week because it looks like it's climbing still. But I fall into that trap, as you might too. But let's follow what the data tells us, which is that we're going to do better when we just stop trying to time the market and
Yeah.
just stick to a disciplined plan.
Yeah. I don't know if you saw that experiment Nick Majuli did. He's a financial professional where he actually went back and gave himself the news headlines for every day and then said, okay, well, and he went back to like the COVID period and said, okay, well, this headline was on this day, so I would have sold this much stock, and this headline came out this day, and I would have bought this much stock. And then
Right.
when he went back and looked at what it would have done to his portfolio, it would have like completely tanked his portfolio. So even having the crystal ball and knowing exactly what was going to be happening in current events didn't allow him to predict the market correctly.
Right. Yeah, totally. And in fact, a little bit of a tangent here, but if our news cycle lately has, I mean, lately for like the past few years, we've heard a lot of noise around like the stock market is way overvalued. We're going to have a massive correction. It's gonna happen. Like when is it going to happen? When is the right time to pull out your money, right? And if you go back to the headlines in like 2013, 2014, same deal. Like, oh my God, the market is way overvalued. We're going to have this massive correction. And then what has happened since? Like unprecedented growth. So, and that's just, it can go either way, but that's just an example to show you that, if back in 2014 you were like, there's a big correction coming, I'm going to pull my money out, you would have lost a ton of money. Same with if you had done that in 2023. So I think that's a really interesting experiment that he did.
Mhm. And one of my coworkers actually had the foresight going into COVID. He had started hearing about, oh, there's this virus. And so he actually sold all of his stock and he sold it at the right time. But then he missed the big spike coming back
Mhm.
up into the market and ended up losing a ton of money in his portfolio versus
Yeah.
just having kept it through the whole thing.
Oh, yeah.
So even if you get it right, like in one direction, you can still manage to lose all of your money.
Absolutely. I mean, I know someone who bought Zoom and Costco stock like at the very start of the pandemic. And so they saw a ton of growth, right? Like Zoom and Costco were doing great during the pandemic, but again, didn't sell at the right time. And both of those companies saw their correction. So it was almost for nothing that they had the insight to buy those stocks early on and then didn't, time it also make the lightning strike twice to sell it at the right time. So um, just all this to say, especially for those folks who are just joining and wondering how did we get here and talking about timing the market again, just dollar cost averaging, not only on the way in, but also on the way out when it comes to needing to take money out or, if you're wanting to supplement your emergency savings fund to say, I'm going to dip into this part of my portfolio because actually this seems like that stock is high right now, despite what everything else is doing, or that fund is high right now, and I'm going to cash a little bit out there to to supplement my emergency fund. Then doing that's an example of dollar cost averaging too, to just little by little over increments of time. Um, so yeah, Prolette said in the chat she didn't sell DocuSign at the right time. And yeah, we feel you. Maybe hold on until the next wave, see if you could time it right then. But I think the psychology of finance is really interesting also because then what happens when we've bought something at the right time and then didn't sell it at the right time? We take losses so much harder than we take gains, right? So, hopefully, Prolette, I hope you saw some really nice gains with your DocuSign, but what the data tells us is that our psychology won't acknowledge that as much. So you're not giving yourself the pat on the back that you should in order to maybe help with the loss a little bit better. And then just one more thing that I want to mention is that if you're someone we've talked about this before, but like if you're someone who just feels particularly anxious, and having more savings is going to give you peace of mind, I'll probably say it a few more times in this conversation, but peace of mind is a financial return. So don't kick yourself for feeling like I'm not following all of the right finance rules and I should be investing this money, but it feels so much better to save it. Like, give yourself some grace for that. That's okay. Maybe don't do that with all of your money, but it's okay to say, you know what, if I lose a little bit of that return on this much money, I'm still giving myself a lot of peace of mind, and that matters to me. Then that's justified, and I just want to tell you that. So that's another reason why you might find yourself in a position where you want to build more savings. Okay, so we've talked about those human elements, and I for sure I know that there are lots of like emotions for me when it comes to investing, and I know that Susan, you and I have talked about this a lot before, and it's hard to deal with the loss, it's hard to deal with the uncertainty. So all of those things matter, and it's not wrong for us to cater to the emotional side of finance. And then if we want to look beyond that and really be able to fall on some more like uh, hard and fast guidelines, that are, a little bit removed from those human elements, there are guidelines that we can have in terms of, well, what about debt? How do we know like when to pay off our debt, when to keep paying down our debt, when to instead use our money, extra money to save or invest? And there are some rules that we can follow, and again there's some gray area here too, but I think that these rules are interesting right now because we find ourselves in a period where we came we're just coming off of a couple years of like pretty high mortgage interest, right? So mortgage rates have been higher than what we had gotten used to in the 10 years prior. And then savings rates really started to drop, right? With when we saw interest rates going down, we were coming off of a period where like in 23, 24, we were seeing that our savings rate was actually kind of nice, right? Like some of us were getting 7% on high yield savings. And that's like unheard of because that's not too much less than the return that we get historically in the stock market. So if you have no risk and you're getting that kind of return, then hey, that's amazing, right? But so now we're in a period where the opposite is happening. Mortgage rates are starting to dip a little bit. They're not at like 7+% anymore. But our savings rate now is much lower. So, I mean, hey, if you're out there and you're getting 7% in your high yield savings account, then DM me. But otherwise, we're looking at like threes, like our interest rates are hovering around 3 for our for that risk-free rate of money sitting in our high yield savings account that we can access anytime. So the question is like, what happens if I have debt that's like 6% interest, and do I pay that off or not? What happens if I have credit card debt that's a lot higher than that? I've got like 18+% consumer debt. Or what if I'm one of those people who had a 7.5% mortgage rate and I'm locked into that now? Like, what should I be doing with that, with extra money? Like, should I be paying down that debt? And where, in 2018, it used to be like, you know what, if you've got a 4% mortgage, like, don't pay that off. Just that's cash that you have to invest, and you can get a great kind of leftover return on that money. And it's not such an easy decision anymore. So let's first take a look at the kind of red light section of how do we make those decisions. And I put this in sort of a red, yellow, green, light visual, just so that we have an idea of like, when should we be like, you know what, I'm going to really prioritize this? When are we like, this is kind of gray area, not really sure what to do, versus when is it like, okay, you don't have to think twice, this is pretty safe. So let's start on that area of like high priority pay down, red light when it comes to our debt. This is like high interest debt, which is hard to classify sometimes, especially because we used to call high interest debt like what people were paying for mortgages 2 years ago. So, um, so yeah, high interest debt, I'm calling here like 7+%, but I want to also break this into two different categories. You can have consumer debt, which is much higher than this. And that is absolutely where you want to prioritize your time and effort into paying down that debt. So that even means like if you have the ability to consolidate that debt, if you have the ability to say, I'm going to transfer that to like that's credit card debt. If I can get that into a 0% APR for a period of time on another credit card, like go all in on saying that's my time frame to then just try and pay down that debt. And that would be an area where I would say that's an exception to that rule of always meet your employer match if you are contributing to a 401k or another employer sponsored plan where you're provided a match. Susan and I always talk about like, do your match. That's part of your salary. Do your match. If you're in a position where you're like, you know what, like I have 22% credit card debt that I'm trying to pay down and I'm still contributing to my 401k, or I'm still contributing that match amount, that would be the one time where I'm saying, you know what, forego the match, pay down that credit card debt. and then pick your match back up. But it is so important to make sure that that high interest consumer debt is paid down. So even though this red light category is here, we're calling it 7% or more, I do want to make a distinction that we're like talking emergency, all hands on deck when it's like, you know, 10, 11, 12 plus percent, because that's the kind of debt that really snowballs. When you're in a situation where you're like, you know what, I've got 7% mortgage, um, that's maybe not as all hands on deck emergency situation. But it's really and by the way, if you have a 7% mortgage, I wouldn't say stop contributing to your employer match. Like still make your match, and instead of saying like then I want to like pay down my principal as quickly as I can, I would say look into refinancing instead. Like you're probably one of those candidates where right now it might make sense to do a refinance. So certainly like look at what kind of fees you'd have to pay and how much equity you might potentially lose and what new rate you're looking at. But I would say that there are options rather than just, hey, I'm gonna really try and pay down my principal here. Why not look at doing a refinance? Because we're no longer in a situation where so many of us are looking at 7% mortgage rates. So that red light is something where, typically above 7%, absolute emergency when it gets above like 11, 12%. And then also, if your debt is variable, so going back, we talked about lines of credit. You might be someone who did get maybe a home equity line of credit in the last couple of years, and you've seen your rate fluctuate. A variable rate is risky. Even if your variable rate has gone down as of lately, you have no guarantee that it's not going back up. So I would also make sure that you're in a position where you have a backup plan to pay down that debt. Or make sure that you're easily able to make those interest only payments if you are on a debt, if you have variable debt. If you have variable debt where you're nearing the end of that interest only period, you might want to consider refinancing that debt as well. So that's something that we've done in the past. We took out a line of credit is something that we used to help finance even some of our investments that can be very risky at the time. We did that because it was very low interest, and we did have a backup plan for being able to pay down that debt if interest rates were to rise very quickly, which they eventually did. But it's absolutely important to make sure that you've got an eye on that interest only period, because once you get to a point where you're no longer paying only the interest and you're also paying down the principal, your payments are going to go up. And that means that if your interest rate is variable and it's also going up, you're suddenly faced with a much higher payment than what you've been used to. So also keep a look out for that, where you might have right now like a 6-ish% debt on your say line of credit. And if that's variable, I would also put that into this red light category of making sure you've got a backup plan to pay that off in the case where the interest rate does go back up.
Yeah, I saw that prediction markets are now giving an over 50% chance that the interest rate will be raised again this year, which, I mean, a few weeks ago, everyone thought it was going down. And
Hmm.
now, the way the war is going and oil prices and
Right.
potential inflation, they actually think there's a better chance that the rates might go up again by the end of the year.
Yeah.
So,
Yeah. I was not surprised to see that. And, again, that's just like, eh, that's an inflation control tool. And if inflation is going up, which oil is a big cause for inflation, that's definitely going to have an impact on our rates because that's a Fed tool to be able to try um, and put a handle on inflation. So I would not be surprised if rates went up. If you're feeling good about having a line of credit with a rate that has gone down recently, just don't get too comfortable. Make sure that you're planning, you have a backup plan for what happens when rates do go back up. Also, especially, sorry, my cat's tail is just right across the screen. If you have, if you're nearing the end of your interest only period, if you didn't know what that is, go take a look at that, at the terms of your loan. Make sure that you are aware of any of those timelines. And now might be a good time to do a refinance if you can, if it makes sense. If that line of credit is something that you need to hang on to. Just doing a quick check on the chat.
Yeah,
Okay.
getting close
Um,
to the end time too.
yeah, yeah. I know. So we've kind of like mentioned some of these, but mid-range debt, this is the yellow light where you might not feel like it's a really easy decision. Like this is kind of gray area. What should I be doing? Is what if my mortgage rate is like only slightly higher than my savings rate? Well, here's the rule of thumb that I think is helpful to think about is, you know, compare the rate that you're paying on your debt, so whatever that debt interest rate is, to the potential rate of return that you might be getting for your money elsewhere. So your savings vehicle is one place where right now, like I said, most savings vehicles are like hovering around 3%. So if you've got, if you've got debt that's less than 3%, then you're in a great position. But most of us don't, right? Like most debt rates right now are higher than 3%. So that might be like, wait, hold on, I'm paying more on my debt than what I'm getting on my savings rate. And that's true, but look beyond savings to, you know, cash that you would otherwise use to invest in the market. The market is still getting a better return than 3% on average, right? Not this day or this month per se, but typically the rule of thumb is look at historically what kind of return can we get if we were to invest that money versus pay down our debt, right? So if we're paying 5.5 or 6% interest on our student loans or on our home loan, well, can we get more than that amount of interest if we were to invest that money? And yeah, most likely we could. And most times, again, like we're not going to get that maybe this month, but it's really important to look at the long term. And also, it's important to compare your tax rate on there too. Some people are like, well, I get like this much return on my savings or on my bond investments or on my dividend investments. It's also important to remember that those returns are going to be your pre-tax returns. So what happens when you put tax into that calculation too? When you're comparing your debt rate versus your investment rate or your interest rate that you're getting in savings. Take into consideration taxes because what we're paying in our on our debt, that's after tax. And so that's kind of the rule of thumb, is to think about what's the difference between those two, the amount that we can potentially get a return on our money versus the amount that we're paying on our debt. And if we're able to get more money, and I would say definitely look for the difference of more than 1%, because 1% kind of falls into that area of like, well, you know what, there's not a whole lot. You should also consider your time and flexibility there. But if we're getting a nice spread on our investment, then that usually is a safe way to say, look, keep your debt and use the rest of that money that you have that you could potentially save to maybe invest, and you're able to get more of a return on that money. But again, what I want to say is that your peace of mind really does matter. And if you're someone who's like, I hate having debt, I don't even want to have like mortgage debt, which is just like fixed and pretty safe, and my home value is increasing over time and my debt is staying the same, but still I hate having debt, then fine, like know yourself and make sure that you're doing what's right for your mind so that you can have that peace of mind. And totally, Prolette is making the point that 3% is close or much lower, right, than inflation, especially as of recently. So, paying that down is actually, it could cost you money, right? So, it's important to think about that too, not just taxes, but inflation. So we're coming up on our time here, but Susan wanted to add a, kind of a real life scenario here. So if folks have the ability to stay on, we'll keep talking through this. If you have to drop, but you had a question that's on the top of your mind, please feel free to jump in. We'll address that first. But if not, we hope that you can stick around and just kind of help us work through this real life scenario that Susan has, and we can also talk through if you've got a real life scenario or you know hypothetical. Feel free to chime in. So, Susan, let's talk about it.
Yeah. So I am going to be pulling some money out of one of my investments. I'm getting some red flags that it's a Ponzi scheme. So I'm going to go ahead and exit with that money. But I'm in this situation now where I'm trying to figure out, okay, what does it make sense to do? Should I pay down some of my debt? Should I keep this money in cash or should I invest it? And so I listed out here what my debt is. So I have over $1 million in debt, but it's all mortgage debt. So it's all on either my primary house or rentals. And my rates are actually pretty good. The highest one right now is 5.2%. That's actually on a line of credit. The other ones are locked in 30-year mortgages. So I'm not in a huge rush to pay them down. I do have medium to high liquidity needs right now and a high cash flow need because I'm not working a W-2. And then I'm also kind of looking into the future. My kids are 12 and 14, and everything is starting to get more expensive for them. I'm looking at probably pretty high expenses for them in the next decade as they start driving, and I have to pay for car insurance for two teen boys and school activities and school trips and college and all that good stuff. So I definitely want to have a little more liquidity and cash flow. So I was trying to think about, okay, well, where does it make sense to put this money? And so I started out and I tagged each of these with red is no, I've decided this doesn't make sense. Yellow is I need to explore this more. And green is yes, this could be a good option. So paying down the primary mortgage is, as Prolette mentioned, right? Mine is at 2.5%. So it's below inflation right now. So it doesn't make sense for me to pay that down. It also won't generate any cash flow for me, really, other than just that mortgage payment, unlike a rental, paying down a rental mortgage. So that was my second option. Okay, so should I pay down some of these rental mortgages? And again, the cash flow generated just isn't going to be good. Rental rates have gone down so much in Austin that I'm just not going to get that much more cash flow from paying down those mortgages right now. So that doesn't really make sense. It's something I could look into a little more. Investing in new rental real estate was another thought that I had. There are some really good deals right now because the market has really bottomed out. And so that is something I'm looking at. But because I need cash flow, I would need to find a deal that I was confident could create good cash flow. It would also increase my liability, right? I would have to be ready for like the AC to go out or need a new roof for, all these things that happen with rental real estate. So that's something I'm considering. High yield savings account, like Caitlin said, the interest rates have gone down, but they're still not bad. So mine right now is getting 3.2%. So it could be an okay place to store money for now and get about what inflation is doing, maybe a little lower than what inflation will do the rest of the year. Short-term bonds, so SGov, that's another place, cash equivalent that I like to store money. They're making almost 3.6% now, so a little bit higher than the high yield savings. Very secure. So that's an option. Money market fund through a brokerage. My money market fund's making 3.93% right now, so also pretty good. That's pretty much risk-free. It's not FDIC insured, but otherwise mostly risk-free. I bonds are currently making 4.03%, and that will reset at the end of this month. And I think it'll probably be higher because inflation is higher. So that's something else I'm looking at. The downside of that and why this is in yellow, you can only put 10,000 in. And also you're penalized if you pull the money out before 5 years. So it's not as liquid as I would like it to be. VTI, just putting the money in a total stock market fund. And this is actually pretty tempting because stocks are on sale right now. I've actually been doing some tax loss harvesting over the past week as the market's gone down to generate some losses and reinvest back into the stock market. And so I've actually been buying more VTI to kind of take advantage of the sale that currently is going on. Private equity and real estate syndications. This is kind of a hard sell for me because it's not liquid. It would have to be like a short-term hold that's going to generate good cash flow. And I was really confident it was going to generate good cash flow to sell me on that right now. And then private credit. I don't know if you guys have been following the collapse of private credit. So these are companies that lend money to businesses. So like business development companies, those type of private and public funds. So you like Apollo, Blue Owl, KKR. A lot of those have started essentially having a bank run on them. Investors have started demanding their money out at a higher rate than is sustainable. And so a lot of those funds are starting to show signs of collapsing. And so that's not something I want to get into right now. I don't think they will entirely collapse, but it's too risky for me at the moment. And then the other one I put is gold. That's been very popular as an investment lately. And I do own some gold funds, but for this money, I mean, I'm looking to generate cash flow, and gold doesn't generate any cash flow, right? It's kind of just a security asset to hold on to diversify your portfolio. It's somewhat liquid depending on how you buy it, but it's not as liquid as cash. Especially if you have physical gold, you've got to find a dealer, and you're going to lose some money on those dealer fees. So that was kind of my thought here. I'm leaning more towards putting this money in like cash equivalents or something pretty diversified like VTI, and then exploring some of these other options a little bit more, like new real estate or some bonds, or maybe private equity if I found a really compelling deal. So I just wanted to kind of go over that to just give you guys an idea of what my thought process was on it. And Caitlin, I don't know if you have any reflections.
Totally. So first of all, we mentioned earlier um, the there's a lot of speculation that rates are actually going to start to go back up. And if that does happen, I feel like for that reason, short-term bonds, short-term government bonds are a nice asset to have. They're shorter term. You can, if rates do go up, obviously the marketability of those bonds goes down. But if they're short term, that doesn't matter so much to you. And then you have the ability then to like, now if you kind of make it a laddered approach, and as those mature, you then get to like invest in a new short-term bond, and therefore you might really find that sweet spot of good marketability there. That's kind of a plug a little bit for short-term government bonds. What I will say is I'm also kind of reiterating what we talked about before as far as dollar cost averaging, and not saying, let's go all in on VTI or all in on short-term government bonds, but instead to use a diversified approach and to be able to say, like, I like the idea of this much money right now into VTI, this much money into short-term bonds. I think that having an approach where you're saying, you know what, VTI right now is essentially on sale. In the long run, that's going to be something that will provide me with some good returns. Right now, it's not going to, but right now I have the potential to put more in my portfolio for less. But the other side of that I like too is, okay, what about the assets that are performing right now? And if you have those assets, those are some of the assets where it might make sense to sell a little bit, because that's going to provide good cash flow. It's a good time to sell some of those assets. But that's why I'm a big fan of keeping small cap and international in my portfolio, because during times like right now, it gives you the option to sell some of those funds, or if you're making dividends on some of those funds, those you're starting to see like still strong dividends on those. Like this is small cap has not had its moment in the last several years, but now we're seeing small cap doing well, whereas large cap is not. And so that's why I like the idea of having small cap in my portfolio, and it gives you that flexibility of saying, you know what, like I I can buy VTI right now. I wouldn't want to sell VTI right now for cash flow. But you could buy VTI and you could sell small cap, and that gives you some cash flow options. Same with internationals in there too. Um, but again, that gives you like flexibility down the road too. Then when things flip, you've got more VTI. You're not wanting to sell your small cap. You can potentially sell off that some of your VTI for cash flow, and small cap is on sale. So
You might end up proving me wrong about the small cap. I know we talked about this on our stock market presentation a couple months ago, and you were really hardcore small cap, and I was like, I'm avoiding small cap, but I think you might prove me wrong the way the market's going.
just always helps to have a variety of eggs in your basket. So this
Yeah,
is
I agree.
this is the time when like the run of the mill white chicken eggs suddenly like not so hot anymore. So it's just nice to have some other variety.
Yes, I agree. And I think that's a good strategy is for me to split the money up into a few of these different options.
Yeah, and also I would like just to be devil's advocate when it comes like on your private equity real estate syndication bullet here. I mean, unless you're someone who's like, I am making moves, I really want to define my portfolio with private equity. I feel like I'm going to go all in on research. I really trust the sponsors I'm investing in. I know that they have a track record. They have a strategy right now that is allowing them to really like get to undercut the market. Um, then maybe you're an exception if you're in that boat. And I'm not talking about you particularly, Susan, but just like general audience. But I would counter that to say, you know what, is if you are going to put money into an asset that is not going to be liquid, that you're not expecting to get money out of for a little while, that's where, I would put in the small cap international argument of, hey, like you're not you're going to put money in a small cap right now and maybe not sell it right away and see where it goes. Same with international. What if you and same with VTI too, right? Obviously, we're gonna maybe buy VTI and not sell it for who knows how long. But it has that same concept of lack of liquidity, where if we can tell ourselves like, hey, I'm going to buy this and I'm not going to touch it until it starts to go up again, then that's kind of the same concept of not having the liquidity that a real estate syndication would, except in my opinion, there's a lot less risk. You don't have to put as much money into it, and it's going to provide you with some additional levers in your portfolio down the road.
Yeah, I agree with that. I think private equity is pretty risky right now, but I also the thing that's kind of just niggling at me is that should I be dollar cost averaging into private equity? Because I kind of all went in at the same time. It all collapsed. Do I need to keep investing as the dollar cost averaging to maybe catch this next wave? Maybe, now the deals are good and these are going to pay off in a few more years. So that's just the kind of thing that I'm trying to consider. Do I give up on it entirely because it burned me once, or did I just come in at a bad time? But if I keep dollar cost averaging, is it going to grow?
Yeah. And I would say like if you committed to having and you still are committed to having private equity in your portfolio, and that's something that you're like, I'm not backing down on. I believe in private equity and I want private equity in my portfolio, then I think that's where the dollar cost averaging argument can be valid. But I also think that you're allowed to say, hey, this is a strategy that I tried and I am really turned off by it. It didn't work for me. Um, I'm not going to take advantage of the distressed buildings right now by dollar cost averaging in and like waiting out the storm. I think it's also okay for us to say, hey, this was a strategy that we leaned into and maybe decided that it wasn't for us. Just in the same way that like not everybody invests in every possible asset. So that's where also it's okay to say, this is not me choosing not to dollar cost average. This is me choosing to like no longer honor a strategy that I thought would work for me. So I'm not saying that that's what you should be doing. I just want to just kind of make the distinction there too for some of our audience is, you know, if it doesn't mean that you're shying away from a dollar cost averaging strategy if you're deciding, you know what, that asset class isn't for me. So putting that out there too. And on this particular argument, when it comes to private equity, there's also REITs, which is like more of the public version of real estate equity or real estate debt is that's another way to diversify our portfolios without having to have as much risk, without having by having more liquidity and by not having to put quite so much money into it.
Yeah, that's a good point too about the REITs. And they're on sale right now too.
Exactly. REITs are also benefiting from distressed properties and real estate debt on distressed properties. So it's another thing to consider.
Yeah. I see Perlette commented that she's not backing down on private equity. So
Yeah. Well, good. I'm glad to hear that opinion too, because that's important as well. Like it's very easy to say, hey, this is private equity had its heyday and now it like bottomed out and so many people lost money. But hey, like we've seen the market do that also. And, you know, how do we know that this is the right time to pull out of private equity, right? So um, thank you for sharing that, Paulette. Cool. Well, I want to just open it up for any other questions. I know we're kind of um, past our time here. I do have like a couple of summary points as far as like when just I want to know when I should prioritize investing, right? And like just to kind of reiterate, emergency funds, while they are so boring and right now, you know, not beating inflation, they are so important and can really be the cause of so many US households going into debt. So it's important not to um, underestimate an emergency fund and not to overlook that strategy. But get rid of your higher interest debt, especially now, especially when we're, you know, experiencing shakier times in our economy. Just don't take on high interest debt. Get rid of any high interest debt that you have. And, you know, when you are looking at a time horizon of over 5 years, and depending on the volatility of the assets that you're considering investing in, over 10 years would even be a great rule of thumb as far as investing goes. And what I mean by that timeline is when you expect to need your money that you're going to invest. If you're putting money into a private equity, I would err on the side of a much greater timeline, right? Like it feels better to invest in private equity when you're like, even though this deal says probably a 3 to 5 year timeline, I'm going to assume I'm not seeing that money for another 10 years. Like that totally will turn your numbers upside down, but you know, it's a good idea to set that expectation for just from a liquid perspective, and just make sure that you have the right time horizon in place for money that you're investing in different asset classes. So that is an important part of understanding when to prioritize investments, especially when to prioritize specific types of investments. Um, and if you're underutilizing your employer retirement match, I know we sound like a broken record with this, but make sure you don't underutilize it. Make sure you're getting your employer match. That's really important. So one exception that we mentioned in this presentation might be when you have very high interest debt that you're trying to pay down, then sure, go all hands on deck, paying off that high interest debt, and then get back to making sure that you're meeting your employer match. And then, you know, if you're in a position where you've got consistent surplus income, then great, good for you. Investing absolutely is a high priority for you, especially if you're in a position where you're like, this is pretty stable. I can start to expect this, and therefore I don't need to add more to my emergency fund. Then yeah, it's a good it's not a bad problem to have when you're like, oh, I got to reassess how much money I have in my emergency fund now because I have all of this extra savings and I probably don't need all of this in my emergency fund. So yeah, go see what kind of investments you can buy on sale right now. Well, just want to thank you all for joining us again, especially thanks to those of you who are able to stick around. And if you've got scenarios that you want to talk through, if you feel like, hey, you know what, we covered something that made me think about a decision that I have to make, and I'm not really sure what to do about it, that you know you can definitely write to us. Feel free to book a free strategy session with us, and we can talk you through how we help women in your position, and you know, just bring your questions, and we'll guide the conversation. And as always, don't be shy when it comes to whatever topics you'd like to see covered on this Wealth Wednesday series, and any questions that you feel like you had and weren't addressed. So don't hesitate to reach out to us.
Thank
Thank
you.
you. Awesome. Thanks so much. We're so glad that you can join us. And but stay tuned in our newsletter. Our next Wealth Wednesday session will be in May, and maybe none of us will be wearing sweaters anymore.
I'll be in a bikini.
Yeah,
Probably be
exactly.
triple digit temperatures here in Austin by then. All right.
Oh, well, thanks everyone for joining. We'll see you next time.